Isaac Newton was the smartest man in Britain, maybe the smartest man who ever lived. He calculated the orbits of planets. He invented calculus. He unlocked the fundamental laws of motion and gravity. But in 1720, he lost a fortune betting on a company that had almost no real business. And when it was over, he couldn't bear to hear the company's name spoken in his presence. Welcome to the Ledger Chronicle, where the vault of history unlocks the secrets of money and power. This is the story of the South Sea Bubble, Britain's first great financial crash, and it proves something unsettling. Intelligence doesn't protect you from collective delusion. Knowledge doesn't shield you from greed. Even genius can't save you when an entire nation goes mad. The year is 1711. Britain has been fighting the War of the Spanish Succession for a decade. The military campaign has been successful, but expensive. The government owes contractors, suppliers, and creditors enormous sums. The Treasury is drowning in unpaid bills totaling over £9 million. Enter Robert Harley, the Lord Treasurer, with a creative solution. He proposes creating a joint stock company that would assume the government's debt in exchange for interest payments and exclusive trading rights. The company would issue shares to the creditors instead of cash. Those shares could be traded, providing liquidity, and the company would make money through trade, allowing it to service the debt and profit. The South Sea Company was born. The name came from its monopoly. Under the Treaty of Utrecht in 1713, Britain secured the Asiento de Negros, the right to supply African slaves to Spanish colonies in South America and the Caribbean. This was considered an enormous opportunity. South America meant gold, silver, and vast untapped wealth. The reality was different. Spain granted Britain the right to send one ship per year for general trade and imposed heavy taxes on slave shipments. The actual trading profits were minimal. The South Sea Company was never a successful trading enterprise. But that didn't matter. What mattered was the story. For the first few years, the South Sea Company operated quietly. Shares traded modestly. The company paid interest to its shareholders from government funds. It was essentially a debt management vehicle dressed up as a trading company. But in 1719, everything changed. The company's directors, led by John Blunt, came up with an audacious new plan. They proposed to take over the entire British national debt, around £30 million. In exchange, the government would pay them interest, and they would convert government creditors into South Sea shareholders. Why would anyone agree to this? Because the directors promised that the company's trading profits would be so enormous that the interest payments would be covered, and shareholders would get rich. It was a spectacular pitch, and Parliament, desperate for a solution to the debt crisis, approved it. But here's the problem. The company's actual trading profits were negligible. The wealth from South America was a fantasy. The scheme only worked if share prices kept rising. And to make that happen, the directors needed to create a frenzy. Shares started 1720 at £128. By February, they'd climbed to 175. By March, 330. By May, 550. By August, they crossed £1,000, an 800% gain in 8 months. The directors fueled the rise through every trick available. They bribed politicians with shares at favorable prices. Members of Parliament, the king's mistress, even the king himself were given stock. Their participation lent credibility. If the king was involved, surely this was legitimate. The company lent money to investors to buy its own shares, using those shares as collateral. This created artificial demand and inflated prices further. It was a Ponzi mechanism wrapped in the appearance of commerce. The public swallowed it whole. Everyone wanted exposure to the South Sea Company, not just the wealthy. Middle-class families, clergy, craftsmen, even widows with modest savings poured money into shares. The excitement was contagious. And then came the copycat companies. Hundreds of new ventures launched in 1720, all trying to capitalize on the speculative fever. Some had legitimate business plans. Many were outright frauds. These became known as bubble companies, schemes with no real substance behind them. A company to extract silver from lead. A company for carrying on an undertaking of great advantage, but nobody to know what it is. The absurdity didn't matter. If shares were being sold, people were buying. Parliament responded by passing the Bubble Act in June 1720, requiring all joint stock companies to obtain a royal charter. The legislation was meant to control the chaos, but ironically, the South Sea Company itself had lobbied for the law to eliminate competition, and the act backfired. Instead of calming speculation, it reinforced confidence in the South Sea Company, which had a charter. Shares climbed to £890 in June, then crossed £1,000 in August. Britain was in full mania. Newton was 77 years old in 1720. He was no longer conducting groundbreaking scientific research, but he remained sharp, active, and president of the Royal Society. He was also a careful, experienced investor who'd managed his wealth successfully for decades. Newton owned South Sea shares early in 1720. As prices climbed through the spring, he became uneasy. He recognized the signs of irrational exuberance. In April, he sold his entire position, pocketing around £7,000 in profit, a 100% gain, a brilliant exit. But then something happened. Prices kept rising. His friends kept profiting. The excitement kept building. And Newton, the man who could calculate planetary orbits, convinced himself he'd sold too early. In late May and June, he jumped back in. He bought shares near the peak, spending roughly £20,000. And then, in September, the crash came. Newton lost everything he'd reinvested and more. The exact figure is debated, but estimates suggest losses around £20,000, equivalent to over $3 million in modern terms. For the rest of his life, he reportedly couldn't bear to hear the words South Sea spoken in his presence. His famous quote captures the tragedy perfectly. "I can calculate the motions of the heavenly bodies, but not the madness of people." If Newton, one of history's greatest minds, could fall for the madness, anyone could. In early August 1720, something shifted. Confidence wavered. Perhaps investors began to realize the company's actual profits couldn't justify the share price. Perhaps it was simply that the last buyers had bought, and there was no one left to sell to. Whatever the trigger, the selling began. And once it started, it accelerated. Shares dropped from 1,000 to 800, then 600, then 400. Panic spread across London. The first installment payments on new share subscriptions came due in August. Many investors who'd bought on credit couldn't pay. They were forced to sell, driving prices lower. The company had lent money to investors using shares as collateral. Now those shares were worthless, and the loans couldn't be repaid. The collapse spread internationally. The Mississippi Company in France, another speculative bubble orchestrated by John Law, was imploding simultaneously. Liquidity vanished. Banks failed. By September, South Sea shares had fallen to £150. By December, £124. Back to where they started. The bubble had fully burst. Thousands were ruined. Families who'd mortgaged homes to buy shares lost everything. Stories of suicides circulated. The public was enraged. How had this been allowed to happen? Who was responsible? Parliament launched an investigation in December 1720. What they uncovered was staggering. Massive bribery. Government officials, including the Chancellor of the Exchequer John Aislabie, had accepted shares and cash to support the scheme. Directors had engaged in insider trading, buying and selling based on advanced knowledge of government actions. The company had used its own money to manipulate its share price. It was fraud at the highest levels. Leiby was imprisoned. Several directors were arrested and had their estates confiscated. The Postmaster General and other officials were impeached. The scandal rocked the British establishment. The man who stepped in to clean up the mess was Robert Walpole. He restructured the debt, stabilized the markets, and restored some confidence. His handling of the crisis propelled him to become Britain's first prime minister, but the damage was done. Trust in financial markets was shattered for a generation. The South Sea Bubble established a template that is replayed throughout history. A company or asset with a compelling story. Prices that rise beyond fundamentals. Insider manipulation, public frenzy, leverage and credit fueling the rise. Inevitable collapse, scandal, and recrimination. We've seen it with railway stocks in the 1840s, with the Roaring Twenties and the 1929 crash, with the dot-com bubble in the late 1990s, with housing in 2008, with cryptocurrencies in recent years. The details change. The psychology doesn't. Each time, intelligent people convince themselves this time is different, that the fundamentals justify the prices, that the gains are real. And each time, when the crash comes, everyone claims it was obvious in hindsight. But it's never obvious while it's happening. That's why even Isaac Newton, perhaps the smartest human who ever lived, lost a fortune. Intelligence doesn't protect you from collective delusion. Rationality doesn't insulate you from social pressure. Knowledge of history doesn't prevent you from repeating it. Today, we live in an era where asset bubbles form, burst, and reform with increasing frequency. Central banks inflate asset prices through monetary policy. Credit is abundant. Speculation is normalized. And every bubble is justified with a narrative about how this time really is different. We mock the South Sea investors for buying into obvious fraud. But are we any smarter? We've bid up stocks of companies with no earnings. We've bought houses at prices that require perpetual appreciation to justify. We've poured billions into digital tokens with no underlying value. Different assets. Same psychology. The South Sea Bubble teaches us that intelligence is not enough. Newton had intelligence. What he lacked was the discipline to resist the crowd. The courage to stay out when everyone else was getting rich. The wisdom to accept that missing a bubble is better than getting caught in its collapse. The South Sea Company didn't dissolve after 1720. Remarkably, it continued operating for over a century, finally closing in 1853. But it never recovered its former glory. It became a cautionary tale, a symbol of greed and folly. The bubble left Britain with lasting scars, but also lasting lessons. It accelerated financial regulation. It created skepticism towards speculative schemes. And it gave the world a phrase that endures, the South Sea Bubble, shorthand for collective madness in markets. 300 years later, the lessons remain relevant. Prices can detach from reality, crowds can be wrong, and even the smartest among us are vulnerable to the madness of people. Isaac Newton couldn't predict it. Neither can we. But we can remember what happened when Britain forgot that prices must eventually meet reality. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.